Welcome, welcome, welcome to this edition of Crashes and Taxes. I am your host for this podcast, Rebecca Walser, and so excited to be with all of you. I hope that you have had a great summer. I have been quite busy. The practice is expanding. We have a new office that we're moving into. Also, I lost one of my parents, so I had some personal situations going on, and it's just been a very crazy busy year with the practice. But I do have a quick market update that I want to give you guys because so many things are really going on right now that are being kind of obfuscated as normal by mainstream news and Wall Street news. And I think it's just really important that we look at these things from a perspective of what's happening, especially right before the U.S. election, which I'm recording this on Friday, November 1st, and the election is obviously on Tuesday, November 5th. So let's go ahead and get started with kind of the things I want to look at today. And the first is really what has happened this morning with the Federal Reserve and our rates. So what I want to remind you of here is that you can see that in the middle of October, when everyone was kind of saying the Fed was late to the game and then maybe they did too much with that 50 basis point cut, you saw the Fed's Bostic basically say at the beginning of October, this is dated October 10th from investing.com, that Bostic signals the Fed might skip rate cuts in November, and that can't be ruled out. So the market was already kind of saying, oh, well, we might not actually get a rate cut in November if things are going along fine. The Fed doesn't have a real reason to continue to be, dovish and stimulative, accommodative, then why would we get another cut? Then you can see that the Federal Reserve's Waller on October the 14th, this is out of Reuters, is saying that they have to be very cautious when they can talk about continuing rate cuts at the next FOMC meeting, which of course would have been this month now that we're in November. So you can see that after the Fed cut, you got a bunch of Fed governors and people out there saying, maybe we're not going to cut in November. It might not happen. So then this happened today. And this was not expected, but actually really a great thing that happened before the election, because I think that people do need to have a reality check that we have been told over and over and over by the Bureau of Labor Statistics, the BLS, that this market is great, the economy is strong, and that Powell has all of the labor strength he needs to continue to cut and to support and be accommodative. And we're just not seeing that to be true. So you can see that, first of all, for the month of October, we expected 100,000 jobs to be added. We only got 12,000. Now, the reason that we got 12,000 was because the federal government alone added 40,000 jobs. So you can see that of this net 12,000, 40,000 coming from the federal government. That means we lost private sector jobs. And in fact, we did. Now, the market, and you can see CNBC here couching this as, oh, it's because of the hurricanes. Oh, it's because of the Boeing strike. The Boeing strike absolutely does affect the manufacturing jobs numbers. However, it absolutely was not impacted by the hurricanes because the surveys incorporated the hurricanes before they came about. Helene was on September 26th, and the one that just hit my house, which I should know, at Milton, that happened at the very beginning of October. So those changes had already been known when the projections were made. And yet we still thought we'd get 100,000 and we didn't. What's more telling and more important is the fact that the BLS revised August and September downwards together by 112,000 jobs. So what that means is the numbers that they gave us, like they gave us the numbers today, we added 12,000. Those numbers that they gave us for both August and September, they went back and said, oh, we were wrong. We overestimated by 112,000 jobs. Now, I have been telling you on multiple crashes and taxes for the last 18 months that this is the most amount of revisions that we've seen by the Bureau of Labor Statistics, the BLS, since the global financial crisis in 2000 and 2009. So there's clearly some kind of agenda. I'm not suggesting it's political in nature. I don't know what the agenda is. I'm not going to speculate. I'm just going to tell you that there is an agenda, because when you have this much machinations of revisions to the downside, that means that there is a concerted effort for multiple months going on to represent the employment situation in a more positive light than it actually is. My personal opinion is that Powell raised rates abruptly and quickly, too fast, and leveraged the fake numbers from the labor statistics data for the last 18 months to support the fact that he left rates so high for so long, when really a lot of asset bubbles, liquidity, bank reserves were all adversely impacted. You can't keep rates at next to zero before you add in risk premium, the Fed funds rate I'm talking about. You can't keep that at 25 basis points for 15 years from 2008 until 2022. And then expect that you can just abruptly raise them astronomically fast and not collapse the asset bubbles that have built up over the last 15 years at the rates being next to zero. So everybody that understands asset pricing and asset bubbles knows that we have massive asset bubbles, and that Powell raising rates to that level for that long without being accommodative is going to collapse those asset bubbles. And in fact, that's exactly what we are on the precipice of seeing happen. So you can see here that the data really spooked people, and that actually makes the markets turn green. So the markets are positive today because they see that this negative employment data is going to make the Fed probably cut rates in November, when, again, I just showed you that at the beginning of October, the data was looking like the Fed was not going to cut and they were just going to have to stay neutral. So now the market is happy that the Fed is going to look to be accommodative again with this jobs miss. But I want to point this chart out to you. I'm going to bring this up to full screen because this chart is hard to read, but I want you to see how irrelevant the Fed has really truly become. This is these are my internal notes that I grab, and I'm constantly watching my 10-year. You can see here this 10-year at 3.645. This was on September the 17th. This is the day before the Fed's 50 bips cut on September the 18th. So you can see that we were at 3.645. And then when you look at the actual 18, this is right before the cut, we were at 3.672. So we actually went up overnight between the 17th and the 18th in anticipation of the rate cut, and Powell did cut 50 bips. So then you think, okay, we're going to go down from the 3.672 because Powell cut, but look at what actually happened. This 3.715, this is September the 19th, the day after the rate cut. And what happened to the 10-year yield? It went up after our central bank cut the Fed funds rate by 50 basis points, which, by the way, is an emergency level cut. We don't usually cut by 50 bips unless there's something major fundamentally wrong. And so then when you go to this, and you can see the blue highlight here, when you go to this number and you see at 4.302, that was our ending yield at the end of October. So from September 19th at 3.75, and you go almost 6 weeks later to the end of October, and you're at 4.302. And this means that even though the Fed cut by 50 bips, we on our own grew back those 50 bips, beyond those 50 bips, and priced in more risk into the Federal Reserve and into our currency. And why do we do that? Why are we pricing now more risk into the yield that it is required for investors to buy? And it's simply because the world is realizing, oh my gosh, all these fiat currencies, in order to continue to make the system work, they can't contract. They must continuously stimulate and stimulate and stimulate. And when you see the level of jobs that we've actually lost, especially in the tech sector has really come up as the highest sector for layoffs for 2024. And that is because a combination of the fact that AI is starting to take over jobs. I think some 25% of Google's code is now written by AI and not actual developers and programmers. So you've got AI that's making jobs go away in the actual IT work programming space. But then you also have companies laying off on tech side because AI has not monetized yet. In other words, a lot of investment, a lot of hype, a lot of hyperbole, just like we got with the dot-com bust and crash in the early 2000s. So it's the same thing with AI. It is a new technology. It is a new frontier. People get really hyper excited about it. And then, and you start to see all of this growth and all of these outrageously outsized evaluations, PE ratios before monetization occurs. And then you start to get reality to sink in that says, okay, here's the real functionality that we can monetize, that we can actually make into a revenue stream. And because that isn't happening as fast as it ever happens, it always takes time. It always has this hyperbole period of, oh, exciting. And then we get to reality of what are the capabilities, and more importantly, because the capabilities are there. I'm not going to in any way suggest that artificial intelligence, which is really more like alien intelligence, if anything, than artificial, it's like technology of another world is what it is. And so that technology is absolutely, certainly valuable. But until you can understand how it's going to be monetized in the modern era, you're going to have pullback. And we've seen that this week in the earnings season of our IT stocks that are based around AI. We've seen pullback because the monetization is not yet there. And so the problem is, as the monetization comes, we will be losing more human jobs. By definition, AI will take over a lot of more processes. It will automatically automate a lot of processes that are done now. The technology is incredible, but the monetization will be overall negative from an employment jobs perspective. And we will be looking at the rise of the machines here. It's kind of ironic that we believe that we can make technology, or we can begin to engineer technology that then will take over for itself, and yet we can still sort of stay in charge of it. And that's what, I want you to understand about this alien intelligence, this AI. That's the whole point, is that this intelligence is self-evolving, self-learning. There is litigation, I've mentioned this before, but there's litigation already that it's sentient, meaning that it can think for itself. And in fact, we do know that there are AI programs that have code in them to shut themselves down, and that as the program gets released to itself to start coding for itself, we've seen that AI automatically starts to try to circumvent the procedures or the syntaxes and the actual arguments, and under which it would start a shutdown procedure. So we do know that AI has some unique things that we're not used to seeing in the standard world of computer programming. And that is something that is going to be evolving through time. We will see, and we will see how it displaces jobs. But there is no economist that I've read that is serious, that has published work that has a history of being right, that believes that AI will not fundamentally completely change the way humans interact and actually work. GDP is going to be affected because you're going to have a lot less people working, a lot more computers working and machines working, robots working. So that is why you have this whole universal basic income UBI discussion, because if we make humans obsolete, and contributing to GDP, a bunch of people just sitting around doing nothing, we have to now provide them enough for their shelter, their food, and their ongoing maintenance. And that is a problem when you're not having that individual contribute to GDP. So there's going to be an entire fundamental shift on the human work capacity. And this is why this is kind of a fourth industrial revolution, if you will. And it's going to take time and really to see how it iterates out. Now, because of all of this that's happening, you can see here that Goldman Sachs has warned this week that the repo market, which is a market that the Federal Reserve has leveraged through their open market operations, and there's something called the lowest comfortable level of reserves, which they now say is around $3 trillion. And this is a big problem because the way Yellen and Powell have conducted their open market operations to fund the U.S. government, which we're running up again on another funding threshold before the end of the year. But the way they have chosen to fund this government on the shorter term in order to keep the yields on the longer term debt from going up, they've really relied on the 2-year, and that is why we had such an inversion for so long. But the SOM rule has triggered. The inversion has been disinverted now for a substantial amount of time. I believe that we're already in recession, and that we will, and it will be declared once the election is beyond us and we start to finally get true economic data. So I just want you to understand that the gold price, and everyone talking about gold being a gold, this is a bull market for gold. That is exactly wrong. This is not a bull market for gold. This is a bear market for fiat currency. This is the collapse of fiat currency beginning that we are seeing. And it's simply because coronavirus stimulus of $20 trillion, the equivalent of $20 trillion, $10 trillion alone in the United States of America, the global equivalent of $20 trillion of currency being printed and put into the system generated so much liquidity that had to be worked through all these years. And we're finally getting to the reality of the situation where people are earning less, goods and services are inflated by anywhere from 15 to 45%, depending on the category, with less earnings, less purchasing power, and now a global crisis that we're seeing in China, we're seeing in Germany. Europe is collapsing. China is collapsing. The Japanese yen carry trade is not completely unwound. That's a 20-year, 2-decade in the making problem that will rear its ugly head again. We're beyond 150 yen to dollar right now. And anytime we're beyond that level, we know that the reverse carry trade is a potential issue. So a lot is happening right now. Of course, the U.S. election is this coming Tuesday. And then we had one more thing that really kind of stood out to me, and that was that the BRICS group, the Brazil, Russia, India, China, South Africa, amongst all of the other member states that they have now admitted, had their annual symposium in Russia because Putin is the this year's president of the BRICS alliance and consortium, if you will. And he was talking about their ability in the East now to use the Enbridge project, which I have brought to you and presented to you, is a massive problem for the West. Because remember, the West, we like to sanction people. We put sanctions on Russia. If they did something wrong, we keep them out of SWIFT. We sanction Iran. We sanction all these groups, and that makes them dealing with the US dollar very difficult. So all these groups have said, forget you controlling us through your monetary supply. We will move to something else. And now you had them form a bloc years ago. Now you have them using and leveraging the Enbridge project. I mean, whether the Bank of International Settlements, which is the central bank of central bankers, just ends the Enbridge project, the BRICS nations know how this can be put together now on the blockchain, and circumventing the West is now going to be the reality. We are not going to ever return to the ability to control the world as much as we had through the US dollar being the world reserve currency. It is over. We are no longer unipolar with the United States at the very top. We are multipolar. We are sharing power now between the West and the East. So as we go into this US election and as we start to see more and more things that are beginning to become unsettled and untethered, I want you to understand that in the transitions of currencies throughout the history of time, the precious metals are the asset class that has always performed the best. So this is not a gold bull market. This is a fiat bear market. This is the collapse. This is the beginning of the collapse of the fiat system. The fiat system and fiat currency is just currency that is not backed by anything other than the full faith and credit of the government that issued the currency. That's all that fiat is. It just means it's backed by nothing. And so this is the beginning of the end of fiat. Simply because you have the East, the BRICS bloc, talking about backing their currency quasi with gold, precious metals, rare earth minerals, and that will force the hand of the United States to once again back our currency with something as well. And that means that our inflation problem that we have today, where we can print however much we want and we can export our inflation to the rest of the world because they must buy dollars to buy petro, that's ending because we already know that there are talks for a petro yuan deal, a petro ruble deal, or a petro euro deal. So if petro is sold by OPEC outside of US dollar, you can be assured that a currency transition has been initiated. You guys, there's a lot going on. I will try to get more active with crashes and taxes as my business is back on settled territory and my personal life is settled. I appreciate you guys having patience with me, and I look forward to this. This is my passion, one of my loves of my life. So thank you guys for hanging with me, even when I'm not here that much, and I look forward to seeing you guys again soon. Take care. If you're worried about all of the global changes, the changes at the U.S. because of our election, the Federal Reserve, the central bank policy, the fact that we have Bank of International Settlements creating a new way around the U.S. SWIFT payment system, if all of these things are things you've never heard from your financial advisor to even if they're not even addressing the geopolitical conflicts and the currency fluctuations that we are seeing in real time between fiat money and gold and silver, then you probably are not with an advisor that has been through a currency transition before, that understands the geopolitical and macroeconomic nature of a global world and our integration into that world. And you need additional support. This is not the time to stay with a buy and hold advisor who never gives you anything other than what rate of return can you get in the next 6 months. We are much more about financial planning and making sure that your situation survives whatever comes. Give us a call, reach out to us, schedule, get on our calendar. We care about making sure you make it through the transition that has already begun. Give us a call. Let us help you out today. And if it's not a fit, no problem. We can walk away as friends. Take care, everybody.
Hey.